Hey everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank. I try to teach you something about finance so you can use it to make money in the future. Today we're talking about bonds, but please be sure to subscribe and get notifications. There's, last time I checked, 57 videos so far that you can check out here, and probably we'll have another 40 or 50 by the end of the summer. So lots of updates. Look at the notes. We try to update those from time to time. And then we have a good books link for Amazon books and my favorite finance books. So what we're talking about in this area is bonds, part one, and it's a bond is essentially a loan. You can go get a loan for a car, a house. Firms can actually get loans from the bank as well, but another security they could offer is bonds, where they typically give up collateral, something is collateral, just like you would your car, your house. But it is a long-term debt instrument in which a borrower agrees to make specific payments of principal and interest. That's not entirely true. A lot of bonds are interest only on specific dates to the holders of the bond. So the key features of a bond, and when I bring this in because we've done a little bit of this on time value money, is that a bond is a contract, and certain things are locked in place because of the contract. The maturity date, the time until the bond actually expires, is locked in from the day it's born. The coupon payment they agree to pay you is written in stone, as is, for the most part, future value of the bond, the par value of the bond, which is usually $1,000. The things that change are the I and the present value, with the I being the price that you'll solve for on bonds, and the I being the yield to maturity. So these are the keys that you will typically use, and this is what they actually mean in the bond world. So the indenture is essentially the bond contract. That's why, of course, the payment and the future value fixed. There's a lot of different provisions. A lot of people call them thou shalt and thou shalt not. Some of them are financial, say, make sure that you maintain certain ratios, current ratios, or maybe times interest earned or debt to equity, that kind of stuff. Others might be, hey, don't sell the bond out from underneath us, use as collateral on something else. But a lot of the provisions we're worried about in this chapter are actually things like callable. It allows the issuer to pay back the bond early. That's a good thing for the company, right? If interest rates fall, they can reissue the bond at lower interest rates, and therefore would not pay as much interest in the future. Of course, when interest rates fall, your bond would become more valuable. I don't know if you remember the whole concept of where you have the $1,000, and then a bond can trade at a premium or a bond can trade at a discount, but everything matches up on the day the bond retires, and it's worth $1,000. But at any rate, once the bond trades at a premium, it's because the rate that the market wants, the yield to maturity that the market is asking for, is actually less than what your bond is coupon rate paying. So that's the condition up here, which means rates have fallen, which means the firms might be interested in going out and redoing those loans at a lower interest rate. There is also something called a sinking fund, and that's why I said bonds, not all bonds are amortizing. What an amortizing loan is when you make a payment to the bank on a car loan or house loan or whatever, part of it is interest and part of it is principal every single month. The interest goes to the bank, it's gone forever as far as you're concerned. The principal is what pays down the loan so that by the last payment you're actually done. That doesn't happen on a lot of corporate bonds. They're actually interest-only bonds, and therefore when you get to the end, the entire amount would be due. So to try to stop that from happening and maybe putting a firm in a bad place, a lot of them will have something called a sinking fund that requires that the loan is paid off through time. It is essentially the amortizing part of a loan when it's not written into the contract. It does greatly lessen the chance the bond will default at maturity, but it can be bad because if rates decline and your bond is trading at a premium up here, and suddenly they want to sink your bond, you'll simply get a check in the mail that says, here's your $1,000 back. So the company can buy directly from you. If it's trading at a premium, they would. If it's trading at a discount, rather than give you $1,000 for your bond that's selling for $800, they would just go buy it for $800 and retire the bond directly in the open market. So basically, the firm always wins. Bonds can be convertible, which is one of my favorite types out there. It means it's convertible into common stock. That's what everything essentially in the world of finance is convertible to when you're talking about securities. So they may say that you can get 40 shares of common stock for the $1,000 that is the face value of your bond. which would of course mean that you're, $25 is the break-even price on that. But you can decide whether you want to turn in your bond. This is a zero, by the way, and get instead 40 shares of stock. The reason why I like that is I'm going to get my coupon along the way, but if the stock happens to go up somewhere down the road, I may essentially get an equity kicker. They can also put a warrant on the bond. And what that means is it takes a long time sometimes for firms to get a bond issue out and about. And when they start the process, 3 months, 4 months, 6 months may go by. By then, interest rates may have changed. And if interest rates have risen and their bond pays a fixed amount, like maybe they were looking at 7% and now the market wants 8%, the market is not going to pay them full face value for that bond. And they actually were raising money for a specific purpose many times, so they would really like to get full face value. So what they do is they attach a warrant. It's essentially a long-term option to buy a certain number of shares at a specific price. So they can actually trade as a separate security, but it's a kicker. It's a sugar that they add to it, so that the deal is encouraging you to do it. Most bonds, while they're callable, they can also be puttable as well. We use this in the financial planning world because what that means is you can make the company give you your $1,000 back, which could be a very useful thing for you. So you can make them buy the bond back. In the world of financial advising, many times we'll use that for an older couple to park their money into, and then if they happen to pass away before the bond matures, you can just make the company buy it back from you $1,000. So it's a cheap way of getting a little better return and your money back when you need it. So an income bond is probably not my favorite out there. It pays interest only when interest is earned by the firm. So it's kind of, hey, if you make enough money, you'll pay me. So an income bond would not generally be what I'd be looking for, but you might get a much higher yield if you do it. And then the index bond is just paid based on the rate of inflation, or truthfully, they have catastrophe bonds and all kinds out there that would pay if there was a hurricane or an earthquake. So there's a lot of different events that could pay off on a bond, and they will set up bonds to take advantage of that. Now, how a bond works, just so you see it visually, is somebody probably put their money in to begin with, gave the firm $1,000. But in this case, you have 10 years worth of payments before the bond matures, and it's a 10% bond, you can tell, because each of the payments is $100. If you remember, it is the rate that you pay times the face value that will actually decide what the payment will be. So 10%, that's how that would work out. In the end, it's 10 years, and because the bond, the market wants 10% and is paying 10%, it's going to sell for $1,000. But it is a bond problem you can see and put it in your calculator if you want to make sure that you're getting it right. We will be doing plenty of problems in part 3 of the bonds. So there is something in bonds called price risk. And the idea basically is the shorter the duration, the shorter the term of the bond before it matures, the less it is impacted by interest rate changes. And the reason why is this one, when you're looking at a year out there and the $1,000 out there, in one case, for the 1 year, when you're going to divide it by 1 plus I for 1 year, in the 10-year one, you're getting the $1,000 back, you're dividing by 1 plus I to the 10th power. So for percentage changes, the denominator gets a lot bigger on these longer term bonds. And you can see that as an example here. They ran that 10% bond you just saw. And if it matures in 1 year and rates happen to require rate went down to 5%, you would, that's good for you, right? It's the market's expecting less, but the bond would go up to $1,048 for a 4.8% change. On a 10-year bond, it would actually go up 38.6%. So you can see the way bigger change on the upside when the bonds, when interest rates fall for a 10-year bond versus a 1-year bond. On the downside, if interest rates rose, the 1-year bond would only go down 4.4%. The 10-year bond would go down a whopping 25.1%. That's why looking at the longevity of the bond, what you're really considering is the price risk. It's going to be more sensitive to interest rate changes on a longer term bond than it is on a shorter term bond, all things else being equal. So what is the conclusion out there? Short-term and or high coupon bonds have low price risk because you're going to get your money back pretty quick. But the problem is, especially for the high coupon, you have to reinvest it, and depending on what interest rates happens, that could be a big problem for you. You can lock in the longer-term interest rates, and for low coupon bonds, this is true. You will have a low reinvestment risk out there because you got it locked in for 10 years, but the bond is much more volatile, so your price risk is much higher. And the bottom line is, in the world of bonds we're really investing out there, nothing is riskless. So don't forget to send emails to me if you wouldn't mind with comments and suggestions, and we look forward to part 2. Have a great day. Bye-bye.